Friends, welcome to yet another video in our series Finance and Investing Tidbits. In this video, we're going to discuss why bond prices are inversely related to interest rate expectations. Now, understanding this issue is very important before you invest in bonds or bond or debt funds, as they are called in mutual fund parlance. And I'm also going to deal with that issue briefly after I explain this inverse relationship. So let's get going. Bond is an instrument which provides either fixed rate or floating rate returns. It also promises return of principal at the end of a particular term. Sometimes in addition to the principal or the issue price, there is also premium which is paid based on the issue terms. In this video, we are discussing bonds which offer a fixed rate of interest over its life. The reason I'm not discussing the floating rate interest is because the problem of this inverse relationship would not arise if the rate of interest offered on a bond is in line with the interest rate expectations of the market. This problem is peculiar when the rate of interest is fixed on a bond. Now, the interest could be paid either half yearly or yearly basis, which is very typical of different bonds. Bond derives value because of its future cash flows. This is true for any asset, whether it is real estate or shares. They all derive value because of the cash flows that investment is going to generate. Now, in case of a bond, the future cash flows include interest on a periodic basis, whether it is half yearly or annually, and repayment on maturity, as we have already discussed. Let us take one example before we go further. Suppose you are entitled to receive an amount from a friend to whom you had given a friendly loan. He has been delaying the repayment. Unfortunately, but that's, let's say, the case. Now, if you had a wonderful opportunity to invest that money somewhere else, say at 18% per annum, every delay, every day of delay is going to hurt you. Instead, if you did not have any other opportunity and the money would be lying anyway in your savings bank account, which is going to fetch you 3.5%, the delay will not hurt you so much. The reason for this is that when expectations are very high, like what we said 18% in our example, if there is going to be a cash flow entitlement for us, but if it is getting pushed further and further into the future, it is worth much less today because of the delay. So if you were to compare amount being received today versus amount being received a few years in the future, the amount received today is far more valuable, and the amount received or going to be received in the future is going to be of much less value. Now this pinches us very hard when our expectations are very high at 18%. On the other hand, if the expectations were just 3.5% because the money was anyway lying idle in a savings account, the hurt will not be as high, because when we convert that future cash flow into its today's equivalent, we would be using only 3.5% as a basis instead of a very high basis of 18%. A bond derives value because of future cash flows. The value is nothing else but a summation of their equivalent present values of all such future cash flows. Thus, the value of the bond would begin to fall when interest rate expectations are rising. As we already saw with 18% and 3.5% example, the pinch with 18% is much higher to us, and therefore any future cash flow is much less valuable to us. But that's not such a problem when the rate of interest is just 3.5%. It will not be a problem at all if our interest rate expectation was just 0%. Then it will not make a difference at all whether we collect money today or collect money 6 months later or a year later or even 10 years later. So higher the interest rate, the pinch for us is very high, and therefore the value of a bond will start falling when our expectations are rising. When I say our expectations, I am referring to the collective expectations of the market, which of course change from time to time. In this video, I'm not getting into those aspects which influence those expectations, but The purpose of this video is just to explain that inverse relationship. Now, what is the lesson for us investors? We should never invest in a bond or a bond fund or a debt fund when interest rates are likely to rise. Bonds are a great buy, on the other hand, if interest rates are likely to fall. For a video which provides detailed bond arithmetic explaining this idea of future value, present value, you can see that video in the description box, or you could also see the link appearing on right hand top of the video. Please click the same to study the bond arithmetic. In this video, I have only explained the intuitive aspect of it, not the arithmetic of it. But if you want to see the detailed video, do see the links which I am providing. For more such videos, do explore our channel, Dr. Abhijit Fadnis. Thank you.